So I was asked to speak on this topic, and it's very interesting because it's an area of research that I'm going to spend a lot more time on, thanks to a recent grant. But it's something that I have been working on for a paper. So I'm going to present the results, some of the results of that paper now, which is about estimating the costs of the fiscal costs of crises relative to the headroom that economies have. And I'm also going to spend some time working through an argument for why bank resolution is in fact the most important policy problem that Ireland has, which is that we need to be able to influence how banks are resolved into the future, and in some sense see if some of the bank resolution that we went through can be retrospectively applied. Okay, so there are three perspectives that I'd like to look at. The first are problems that we have, some solutions and some barriers. I've been trying to teach my son maths, but I don't want to teach him the way I was taught, which is there's the rule, change the numbers, there's the answer. You know, this kind of they don't understand why I'm doing it thing. I want to teach him how to solve problems and why mathematics is useful. And so one of the books that we're going through at the moment is George Polly's How to Solve It. It's an amazing book. From 1990. So he says, how do you understand a problem? Well, he's talking specifically in mathematical terms, but I think it's because math is the most general. And I did maths in college. I like this approach. What is the unknown? What is the unknown when it comes to fixing the European system? What is the actual unknown that you'd like to solve? What are the data? What is the condition of the system that you're in? Is it possible to satisfy this condition? Is it possible, ladies and gentlemen, in your opinions, to simultaneously have balanced budgets, properly resourced and enforced banks, and growing economies at the same time, consistent with full employment? Can you have those things? It's not exactly a trilemma, quadlemma, I suppose. Is the condition sufficient to determine the unknown? Can you actually solve this problem? Probably not. Is it insufficient, redundant, contractionary? Can you draw a diagram? I like this one. Introduce suitable notation. Separate the various parts. Can you write them down? I like this approach. It's reductionist. It tends to separate the ideas out as much as you possibly can. What it leads you to is a notion that, in fact, there is an analytical solution to the problem. He says, right, once you've understood the problem in this way, devise the plan. How are you going to solve it? This is before you come up with your theorem or whatever. How do you solve it? You find the connection between the data and the unknown. The connection is the most important thing. Once you have the connection, you're in reasonable shape. Have you seen this thing before? Have you seen the same problem in a slightly different form? Can you think of a familiar problem having the same or similar unknown? Could you restate the problem? These are Polly's words. This is Polly's method for how to understand, how to solve any mathematical problem. Could you restate it differently? Go back to your definition. Okay, so let's just go through some of Polly's stuff. What is the problem? How do we understand the problem? The problem is the size and interlinking of the banking sector. That is the problem. That is the problem. People are talking about austerity and unemployment and sclerosis and Angela Merkel's hairdo and all the rest of it. That's not the problem. The problem is the banking system and the interlinkages of it with sovereigns. The European Eurozone has a very large banking system and very large banks, and they're in poor shape. There are 8,000 monetary financial institutions. They're worth about 43 trillion. They were worth about 43 trillion euros in 2008. They're greater than 350% of Eurozone GDP. This is according to the Liikanen report in 2012. Sovereign indebtedness is a serious issue, and not because of some rubbish Rogoff and Reinhardt 90% rule, but simply because most countries in the Eurozone have quite a lot of debt. Germany, for example, has 81% or 80% of debt to GDP. So if you want Angela to spend, she can't spend more than about 120% for GDP. There's a fiscal headroom issue. So she has about 40% of Germany's GDP. Now that's a lot of money. That's a lot of money. It's approximately 1 trillion euros. That's how much Angela Merkel could raise if she wanted to spend her way out of the problem. Why she would want to do that, is beyond me. But if she wanted to, that's how much she could do. So sovereign indebtedness at this moment is a key issue. There's a lack of fiscal headroom. And the problem is, and I'm going to show you some data in a moment, the banks are so large that even if they decided to go all out Keynesian, nationalised a lot of it and everything else, they couldn't do it. Now the institutional immaturity that the Eurozone has simultaneously amplifies and damps the effects of any shock absorption mechanism. Okay, it amplifies it in the sense, or in the case of Ireland, because we're tiny, we're a peripheral economy, but it damps that effect in the larger countries like Germany. Okay, the ECB as a playmaker is totally inadequate for many reasons, but mostly because they're legally constrained. They just can't act outside of their remit, and when they try, they inevitably get slapped down because it's a political constraint that they're under more than anything else. This is a sidebar, but it's actually quite important. There is a shocking democratic deficit amongst the key policymakers. I had a piece in Foreign Affairs last year called "The Twilight of the Technocrats," and my worry was when Monty had done his thing, when the Troika had done their thing, and if they failed, and all political careers end in failure, what would that mean for the status of the technocrat? What would it mean when technocrats failed? You know, what if Super Mario isn't quite so super? That's the worry, I think, that I have. And I think we may be in the twilight of the technocrats right now. So size matters. So this is from page 12 of the Liikanen report. What you're looking at is the total assets of the banking systems of the EU and the USA. In trillions of euros, 42.9 trillion in the EU at its height, 8.6 trillion in the US. Total assets as a percentage of GDP, 349 and 78. And the top 10 bank assets, and this is probably very important, 122% of EU GDP. Now, EU, not Eurozone. Just to note the difference there. But given the relative size of the Eurozone and the European Union and their banking system, I think it's a pretty good comparison. Now, 2 points to note there. Number one, we're looking at the European Union here, not the Eurozone. And number two, many of the banks, the monetary financial institutions that are in the US actually have a lot of their funds in Europe. So there may be some double counting there, okay? That said, even if you take both those qualifiers away, that is still a staggering amount of money. Staggering amount. And it means when you consider this piece of information coincident with the ability of sovereigns to actually bail these guys out, then you understand the scale of the problem and the constraints that the policymakers are under. They literally can't afford to bail these guys out. Deutsche Bank and Commerzbank combined are bigger than the GDP of Germany. If either one of those banks goes, or even starts to wobble, the entire European project may fall apart. This is the problem. And you can see the unwinding of these positions in the following figure. What you're looking at is the total monetary and financial institution assets. So you can just think about these as the liabilities of every banking system from 2001 to 2011. Again, this is from the Liikanen report. And what you see, the big red line sort of jumping up and down is Ireland at the very top. The value of our financial assets collapsing. You can see the scale of our collapse. But I think it's important that you note. It's important that you note that Ireland is there beside Germany in terms of its the size of its financial system relative to its GDP. So really scary numbers. And what's important is that while Ireland is correcting itself, the rest of the European economies are not. So, where do we move on from there? I just want to make a digression because I saw Professor Stewart's presentation. Of course we're a feckin' tax haven. We are a tax haven. Yes, we are. I was teaching I got into a lot of trouble last year with the Chartered Accountants Association of Ireland when I suggested in the Irish Independent that yes, of course we're a tax haven. They said, no, here's the OECD definition. I said, no. Look, just look. This is the percentage of financial assets to GDP. There's Luxembourg, Ireland, Malta, Cyprus, the UK. We do something very strange with other countries' financial assets. I think this is an indicator that we need to be worried about. And given how Cyprus has evolved, I think and you know, given that we're in the same status as Luxembourg, I think this is something that we need to be a little bit careful about. Anyway, back to my scheduled presentation. Okay, so here's some research that I've been doing. I've been looking at the fiscal cost of banking crises and trying to understand them using a database from Luc Levin and Fabien Valencia from 2012. They're from the IMF. And what they looked at is every banking sector bailout for the last 70 years. And what they found essentially is most of these are zero. Most of the time it's a guarantee. When the banking sector gets into trouble, there's a guarantee. The guarantee is there, everybody calms down, the guarantee is rescinded, and the government doesn't need to spend any actual money. Sometimes the government does need to spend money. And when it does need to spend money, you can see that it can be up to 60, 70% of GDP. I think Indonesia is the worst. But second worst is us. Ever. Which is kind of scary. So imagine it's 2008, sort of September time, and you're in your office, which is on Marion Square, and some people come up to you and they say, "Hi, how's it going? I've got some bad news and some good news. The good news is nobody will die. The bad news is you're going to have to write a check. How much? Well, we think probably it could be maybe, give or take, 5 billion. What? 5 billion? That's amazing. Gee. Who wouldn't give... can you imagine if it actually only cost us 5 billion? We'd all just high-five each other and go to the pub, wouldn't we? It'd be amazing. But no, it's been slightly more than that. So we said, okay, right, fine. How much am I gonna have to pay? If they had had this chart, if they had had this chart and had it explained to him, I don't think that they would have done that guarantee. What this says is this is a probability. Well, you can think about this as a histogram. Okay, so it's what it's saying is if you want to bail out your banking system, you roll a dice, but it's not a six-sided dice. Okay, on one side is much bigger than many of the others. Okay, so there's a chance that you're. Can you see the thing? There's a good chance. You know, this is the density. The distribution is kind of here. There's a good chance that it's going to be between 5 and 10% of GDP, which would be politically very expensive, but you can get over that. You can absorb that. You have enough fiscal headroom to absorb that. So here you are. But occasionally things get really bad. Here you are, yeah, and occasionally you're down here, Ireland, Indonesia type stuff. Okay, now there's a distribution that fits this. Most of the statistics you learned in college and school was the normal distribution, the bell shape, which says that you've 2.5% of the people are less than 4 foot tall, and 2.5% of the people are above 8 foot tall. But you never see any 25-foot people, and you never see any 1 foot people. Okay, this is a 65-foot person. Okay, that's what this says. That's the tail of this distribution. It's extremely tall. So what they're saying is, yes, Mr. or Ms. Minister for Finance, yes, you can bail out your banking system, but it may cost you half your economy to bail them out. Would you like to play this game? Now, if I was, most of the politicians I've ever met are very conservative people. Most of them would have said, well, I'd rather not do that. We'll think of another way to do this. And here they are. Now, the best fit, now we did a load of various statistical things, which I won't bore you with, but basically we tried to fit the best distribution we could to these non-zero fiscal costs. And what we found was the Weibull distribution is the best, using something called the Akaike information criterion and the Bayesian information criterion. It's the best fit given the data. It's that sort of blue one. Now what the Weibull distribution tells you is that the only theory that will let you understand how these movements work is called extreme value theory. Now, when I say fiscal costs and the words extreme value theory, you should be getting nervous. And it means that the way to understand these things is is that they're probabilistically very scary. They're very scary. These are sort of tsunami levels. So as the finance ministers, you may be in this situation. So why would you, as Angela Merkel, turn around and say, yeah, no, I'll happily put my credit card, into my neighbour's hands for some amount of money that will be determined later? This is, I believe, a very good motivation for not doing this sort of stuff. So sovereigns can't bail out banks. Into the future, I think the Eurozone has sort of absorbed that lesson. Sovereigns can't bail out banks. The only thing that will work is a resolution mechanism or a living will structure. Now, I've been arguing that a living will structure is not the best way to go. And I have an article, which I won't bore you with the argument, which essentially says that living wills are not credible in an Anglo-level banking bailout. If you're in a situation where you say, well, in the event of a bailout, these are the creditors that are burnt, and here's how it's going to roll, that's fine as long as it's sort of a 1, 2, 3% of GDP fiscal cost. But if it's 60%, then the living will is not credible. You simply have to make it up as you go. And the policymakers will make the stuff up on the fly. Okay? So the resolution mechanism can't be at the national level. It has to be at the European level. That creates complexity issues around supervision and governance. Who guards the guardians in a certain sense? And the governance issues are about complexity, coordination, and control. The system is too complex. Coordinating it is very, very difficult, and there's probably no aspect of control. The ECB, the worry that I have is the ECB is yet again the playmaker, although there's been something of a Keynesian stimulus for economists, because they're going to hire more than 800 of them. I don't know how you hire 800 people simultaneously, just everybody with the blue eyes gets the job or something. Anyway, it's a very interesting process. But this is part of this institutional evolution, I suppose, that we're going to see. Okay, finally, austerity and bank resolution. They aren't actually connected, and they shouldn't be. Austerity is wrong. It's just the wrong policy at this time. At most times, austerity is the wrong policy. Fiscal consolidation is important, actually. I would be somebody who would argue for fiscal consolidation, but not right now. It can wait until the economy is growing a bit. One qualifier I would have is that there's a really excellent paper by Corsetti and Dedala called "Is the Euro a Foreign Currency to Member States?" In other words, is it priced differently in different member states? I would actually, I would actually kind of agree with them. Certainly in Cyprus, it's a foreign currency. It's even a foreign currency internally as well. If they're correct, then we need some way to price the currency in our different countries. And I quite like this quote from their paper. What ultimately matters is the ability of the central bank to swap default risky debt with reserves, reducing the cost of public indebtedness. That's exactly what Article 123 of the Maastricht Treaty says we can't do. The ECB can't do this at the moment in a serious way, but that's the solution. The solution is for the ECB to evolve. Okay, so what's the unknown? The unknown is the extent of bank losses and their implicit guarantee by sovereigns. Is the condition sufficient to determine the unknown? No, it's not. It's not. There are more variables in play. Can we separate the various parts of the condition? Yeah, you can. Banks, sovereigns, the markets. Have you seen it before? Yes, you have. The last time you saw something like this was the US in the 1780s and the experience of Alexander Hamilton and knitting them together. Fortunately, or unfortunately for Hamilton, he had just had a war behind him. So he could use the impetus of the war to generate these new institutions and federalize a lot of the state-level debt, which knitted the United States together. We haven't had a war, unfortunately, or fortunately, I don't know. Could you restate the problem? Here, how can you build a bank resolution mechanism to insulate sovereigns from private banking losses? I think that's the key policy problem, and that's how you're going to fix the European problem. So thank you very much for your time. Cheers.